Hey everyone, welcome back to Corporate Decoder. Today we're diving into Charter Communications' latest quarterly report. Get ready for a roller coaster of numbers because if you thought untangling your TV cables was hard, wait until you see their financials. Charter Communications, one of the biggest cable and internet providers out there, just dropped their Form 10Q, which is like a report card for the first 3 months of the year. It tells us how much money they made, how much they spent, and what they're worried about. Let's break it down in simple terms. First up, the balance sheet, which is a snapshot of what the company owns and owes. Cash and cash equivalents, or how much ready money they have, increased to $796 million last year at the end of last year. Their accounts receivable, that's money owed to them by customers, also went up to $333 billion. That means people are paying their bills or at least promising to. Overall, their total assets, everything they own, are about $159 billion. On the other side, we have liabilities, or what they are accounts payable, which is money they owe to suppliers, is around $11.8 billion. They also have a lot of long-term debt, sitting at almost $92 billion. So they own a lot, but they owe a lot too. Finally, the amount of money the shareholders would get if the company sold all of its assets and paid off its debts is $20.5 billion. Now, let's look at the income statement, which shows how well they performed over the last 3 months. Total revenue was around $13.7 billion. Operating costs, the expenses they had to pay to keep the lights on, were about $8.2 billion after subtracting all costs and expenses. They had an income from operations of around $3.2 billion, which sounds good. Their interest expense, the cost to service their massive debt, is $1.2 billion. After all of that, consolidated net income after taxes was $1.4 billion, a little more than last year. Net income specifically for Charter shareholders was about $1.2 billion or 8.22 cents per share if you divide the profit among all the shares. That means if you own a share in Charter, you technically made 8.42. At least on paper. Time to look at the cash flow statement, which shows where the money actually went. Starting with their net income of $1.4 billion, they had to make some adjustments. Depreciation, accounting for the wear and tear on their equipment, was $2.1 billion. After all the pluses and minuses, they got about $42 billion in cash from their regular business activities. They spent about $2.4 billion on new equipment and upgrades. They borrowed $1.4 billion in new long-term debt to finance things and $802 million to buy back their own stock. After all is said and done, their cash increased by $360 million for the quarter. Charter has a lot of debt, about $93.7 billion. It might sound like a scary number, but big companies often use debt to grow. The fair value of their debts, what they are actually worth on the market today, is around $83.4 billion. Where does all that money come from? A large chunk of their revenue, about $5.9 billion, comes from internet services. Mobile is catching up, pulling in $914 million. Video is still a moneymaker, bringing in $3.5 billion, but is losing ground. Most of the revenue is from houses and apartments at $10.7 billion. Businesses are good too, with $1.8 billion. To manage risk, Charter uses some fancy financial tools called derivatives. They're using cross-currency derivatives to protect themselves from changes in the value of the British pound, since they have debt in that currency. The value of these instruments is about $517 million, and it helps keep their finances steady even if the pound goes up or down. Now, what are the risks? The report lists a bunch of things that could go wrong. They include keeping their customers happy and getting new ones, especially with so much competition. Having to compete with other companies that offer the same services, such as phone companies or satellite providers. Government rules and regulations could cost them money or limit what they can do. Paying for TV channels and content and being able to charge enough to cover those costs. The success of their deal to combine with Liberty Broadband. Even though Charter offers a lot of different services, they only have one reportable segment. That is, they don't really look at different revenue streams individually. This is because everything is delivered over the same network. It's like a restaurant that sells burgers, fries, and shakes. They care about the total bill, not how much each item costs individually. Programming is still the biggest expense at about $2.3 billion. Here is one of the more interesting things. The company is buying back its own shares, and as of the end of the quarter, the number of share buybacks totaled 2,276,635 million shares. The company has some non-controlling interests. These are basically small investors who own a piece of the company, about 10%. These guys don't have a controlling stake, but need to get their share of the profits, about 191 million yen this quarter. So what's the story here? Charter had a decent quarter with improving customer results and growing mobile. Expenses are down, which is great. However, they still have a mountain of debt. They are doing okay, but have to watch the debt and make sure they can keep growing revenue to pay it down. Looking ahead, Charter seems to be focused on the right things: network upgrades, expanding into rural areas, and offering better deals to customers. However, they need to keep an eye on the competition, especially from companies offering wireless internet. Also, that huge debt load is always a risk, especially if interest rates go up. Overall, Charter is a solid company in a tough business. I would say they are moving in a decent direction. It's not a rocket ship, but they are slowly improving. Thanks for watching Corporate Decoding. If you found this breakdown helpful, be sure to like, comment, and subscribe for more deep dives into the world of corporate finance.